Good afternoon. Good afternoon. It's Monday, the 16th of June. Welcome to another edition of Monday Market Picks. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities in Singapore. The Middle East escalations, especially with Israel and Iran's conflict, is going to make the markets very, very choppy this week. But that's not the only big concern. We also have data coming out from China throughout today that will also add to the uncertainty. We've got industrial production, home prices, retail sales all coming out. In fact, retail sales just came out just a short while ago, and we did see some pretty strong numbers there. But with all these external factors, which are not really easy to quantify and measure, we actually turn inward in our show today. We're actually going to be looking at the domestic market and particularly in terms of the equity market reforms and what that means, plus some of the internet champions and how all of that could actually drive us to some superior returns. So let's jump in. In today's show, we're going to be talking about the MAS Equity Market Development Fund. Is that actually going to make a difference? We actually give a definitive answer and also some stock picks as well. Husseini thinks that the stage is set for the internet names in ASEAN to really take off, and we ask him why. We also have Bunyakorn, who's upgraded AOT, which is a stock which is down 50% in the last 12 months. And he's going to explain why he's turning bullish on this stock. We've got Jarek highlighting a buy on Frencken, which is also a bit of in a sector that has been battered in the semicon space. And we look at why that is the case. Plus, we've got our chart guy, Amirul, as well, with some new trading ideas. But let's fly to Thailand first and have Bunyakorn join us, where he's upgraded AOT to a buy. Remember, AOT is a SDR stock that is tradable on SGX. Bunyakorn, welcome to the show. Now, as I said, the stock is down 50% in the last 12 months, especially given all the issues it's had with King Power duty free. What's making you turn bullish right now?
Okay, hi. So this morning we turned a bit positive because of I think we think that the negotiation for KP, which is the King Power duty free operator at AOT airport, right? They're going to negotiate. It's going to take 45 days, but the thing is, the market seem to price in let's say a worst case scenario that we think that the scheme for the concession fee, right, will turn to be on revenue sharing from the previous contract, which is based on the minimum guarantee payment. So I think that the duty free issue, right, which has been haunted AOT for a long time. I mean, for the past 1 year, right? I think that's it's gonna end soon. So the management will talk more about other positive things like what is going to be a key driver for revenue to offset the foregone revenue from the duty free concession. So I think they will have analyst meeting this afternoon, right? So the management gonna talk about how to recover those revenue, right, from the aero side. The aero side, we have a lot of positive upcoming positive catalysts, including the PSC uplift, passenger service charge. We never charged that above 700 baht in the past 20 years, so we fixed it. It has been fixed for a long time. So we would like to hear more update from the management on the PSC, also the other concession revenue, right, that the contract will end. So the AOT is able to charge more on those concessionaire. Yeah.
Got it, got it. Now, Monikon, I get the fact that you may actually see some positive moves, particularly on the King Power duty free. But what's as you said, the market's also kind of looking at the worst case scenario. So let's take a step back and go, what could be the worst case scenario, especially when it comes to these King Power negotiations?
Okay. So the worst our assumption right now we turn a bit bearish. We used 20% revenue sharing instead of minimum guarantee that King Power AOT gonna lose probably about 5 billion. So from changing the scheme from minimum guarantee, we call it MAC, we changed to revenue sharing scheme. The worst case could be, a percentage could be lower than 20, but the 15%, let's say 15%, compared to global average, right, is nobody offer a concession fee at about 50%, 15%. 15% is too low. So we think that the worst case for us is the 15% revenue sharing, which we see about only 10% downside in earnings and target price.
Got it. So what should we be looking out for in terms of positive catalyst for the stock for your buy call to work?
Okay, so I believe the market digests negative news on duty free issue. So more upside will come in the upcoming month. The earliest one should be the PSC uplift. As I say, it has been fixed for 20 years. To lift the PSC to the ASEAN average, right? Should be some a lot of upside to AOT consensus earnings. The second thing is about, they're trying to gain more revenue from other source, not duty free. We're going to do some airport city. I think we expect to hear some update on the project in the upcoming afternoon meeting. Also, we expect to hear more about, the recontact of concession or the concession at AOT, because most of the concession will end this next year. So I think we should hear more upside, for AOT in the upcoming analyst meeting session.
Got it. Thanks so much, Munikon. As I said, AOT is a stock that you can trade on SGX as an SDR. Okay, now before we move on, there's a couple of questions, and I think they're kind of similar. One, John is asking, should I ignore geopolitics as a long-term investor? If no, how should the situation in the Middle East affect my decisions? And then we have Jeffrey Chan asking, any hope for oil prices? Will it affect stocks like Rex? I mean, I think short term, we've had just a little while ago some of the large oil tank operators saying that they're starting to not take orders to sail through the Straits of Hormuz. So we are going to have continued disruption, particularly in terms of the supply chains in the overall oil and gas complex taking place over the next few weeks. So I think the negative impacts from a lot of this will continue to drive a bullish outlook for oil prices, at least in the near term. So I think from a trading point of view, some of the oil majors and some of the more oil exploration companies will probably see some opportunities for upside. Now, if you take a longer term view, I think the geopolitics start to matter less, in my view. I think then it really comes down to what I would like to say is using volatility wisely. You do have when you do get situations like this where you can actually get high quality, well-run companies for cheaper, and in markets where you do have structural growth, I think that's something that you should be looking at. So I mean, I think in terms of investing, especially over the longer term, and you look at any sort of indexes like the S&P, which over time, despite massive macro as well as geopolitical as well as COVID, you've generally had the market rebalancing and re-rating upwards. So I think the key in that sort of longer term investment horizons is to stay invested, and also to be very clear in terms of the type of stocks that you want to be in, which are more high growth, high quality, good management, good balance sheet sort of stocks. And that kind of gives us a segue to come back to Singapore, which I think will be one of the key markets that will benefit from a lot of these uncertainties in the geopolitical arena right now, given we've got some very good quality companies as well as policy certainty as well. Now, one of the key questions I get a lot is this whole EQDP really going to work? There's been a lot of discussions around it, and there's been views on both sides of the aisle on this, whether it will actually be effective in raising market valuations or liquidity. Now, we actually come down very squarely on the side of optimism. Institutional funds are expected to be qualified by the third quarter, and on-the-ground checks are indicating that already about 5 of them have been qualified. We think the mandates for Singapore investments will skew heavily towards the non-index stocks. And also, I think a lot of the REITs will get excluded, especially seeing the adjustments that they made on the GIP wealth management side, where they excluded REITs as well. So we think deploying about $5 billion into the Singapore market can actually have a material impact. Look, if you look at Singapore, SGX's average daily value traded, around 80% of it originates from the STI index stocks. So that leaves only about 200 million of the 1.3 billion that trades daily for the rest of the market. So when you actually have $5 billion coming in, that's about 19 times more of that traded value. So in terms of liquidity, I think there is some potential for positive surprises there. Now, in terms of stock winners, we see a lot of commentary around valuations, growth, and liquidity. While these are valid metrics, we think the biggest determinant for institutional investors, remember this money is going to institutional investors, when they start looking at mid-cap stocks, and for a lot of them, this will be the first time they're looking at that mid-cap stock segment in Singapore. The biggest determinant will be corporate governance. The elephant in the room, and I think this is something the audience here very much recognizes, is that the Singapore small and mid-cap stocks have had a very patchy CG track record in the past. We've had big cases like Asia Suns, Bluemont, Lion Gold about 10 years ago. We had Best World and even Cinemas Land quite recently as well. So this will be an overhang for a lot of institutional investors that they will need to overcome, particularly in terms of concerns around minority protection, as well as looking at stock manipulation, capital structures, and so on. So we think professional money will prioritize corporate governance first when they're deploying capital. So in searching for potential stock beneficiaries amongst the mid caps, we've actually run a corporate governance screen on all the stocks that can qualify for this. So excluding the STI, excluding the REITs. And we used our Maybank's own proprietary ESG scoring system, which I think is probably one of the most comprehensive around, particularly when it comes to small and mid caps. And what we've done is we've run secondary filters after that on things like earnings growth, liquidity, balance sheet quality, and so on. And that's actually thrown up 18 names, which you can see on the screen right now. You can actually also get the full list of those names from our newsletter today as well. But some of the key stocks to highlight are names like Centurion, Comfort Delgro, CSC Global, Food Empire, Singpost, UMS, which are all stocks we cover and which we have buys on, along with names like IFA, SATS, and Sheng Siong as well. So do have a look at this comprehensive note in our newsletter today. Now with that, let's bring Hosseini onto the show. He's just done a brand new survey on the internet usage within ASEAN. Hosseini, welcome to the show.
Hi, Thilan. Hello.
Great.
Thanks
Good
for
to see
having
you.
me.
Good. Hosseini, now first, you've done this big survey. So first, catch us up with the parameters of this survey and what were you trying to achieve?
Yeah, sure. So we surveyed around 220 consumers or more than 220 consumers in ASEAN across 6 markets, as well as we surveyed around 40 e-commerce sellers in Indonesia and Singapore. We also scraped through the e-commerce platforms in all the 6 ASEAN markets, as well as in Brazil, to compare the pricing competitiveness of various platforms. we also did a similar thing on ride-hailing apps as well. So
Got
what
it.
we were trying to achieve was can the strong growth momentum of the last few quarters can sustain going forward? Does platforms have the pricing power to increase margins, and how the platforms fare versus each other? So those are the few of the areas we are trying to gauge through these consumer surveys.
Got it. And what did you get through that? What were your read-throughs?
Yeah, we came very positive from the survey. So first, on the e-commerce side, consumers are less price sensitive. For instance, 50% of the consumers think that the price increases on the e-commerce platforms are less than that of offline price increases, and as such, they are not looking to cut on their spending on e-commerce platform despite price increases. Also to note is that a bigger proportion of consumers are using e-commerce for necessities than discretionary item, which kind of reflects the defensiveness of these platforms. Uh, Even the sellers on the e-commerce platform are also less sensitive to commission increases. So from all these things, what we can gauge is that the growth is likely to sustain as consumers are very positive, and there is also a potential for the platforms to raise seller commissions as sellers are less sensitive and positive about the outlook. We find a similar feedback on the ride-hailing, and food delivery, that the consumers are less sensitive to price increases, and they continue to spend a fair bit on these platforms. Also to note is that we see an increasing preference for the larger platforms like Shopee, Grab, and Gojek across ASEAN. And finally, on the pricing side, as we scrap through the various platforms, we find that Shopee prices are 20 to 25% cheaper than that of other platforms like, say, Lazada or TikTok Shop, and 11% cheaper in Brazil. Similarly, we find Grab pricing cheaper in Indonesia and Singapore.
Got it. So you talked about Grab and C right now. So, how should we think about the buy ratings there? And especially for C, I noticed that Mercado Libre in Brazil has been upping their competitive pressure with price cuts and with free delivery, which is also a stronghold. Latin America is a stronghold for C. So what are your thoughts there?
Yeah, sure. So first, on the back of ASEAN survey, what we have done is that as we came out positively, we increased our estimates, GMV growth expectations and estimates around 2 to 3%, and have raised target price for both C and Grab. Now, coming to the point of what is happening in Latin America, so is that Mercado Libre, which is the number one operator, they came out with a free shipping campaign even for low ticket items like $3 or so. So now what this suggests is that Mercado Libre is trying to move into the stronghold of Shopee, or trying to move into mass market, which is the stronghold of Shopee. Now, when we take a deeper look into this, we see that it is a bit of a measured escalation, and it is not a competition war which they are initiating. Also to note is that even with their shipping subsidies, what we find is that the overall commission which Shopee charges in Brazil is even lower than that of Meli, even with Meli giving the shipping subsidies. So net, we are of the view that Shopee still remains a more competitive platform. Also, if we do the price comparison, and we discussed that a little while, that the prices on Shopee platform is 11% cheaper than that of Meli or Mercado Libre. So net, we are of the view that Shopee remains very well placed in Brazil, and we don't see it leading to competitive escalation or competition war.
Got it. And just very quickly, Grab is doing a fundraising with some convertible note issues. But they've said that the Grab GoTo merger is not happening. So why are they raising money very quickly?
Again, I don't have a very good answer to that. They already have 6.2 billion in net cash liquidity. I don't see them. I mean, if they say that inorganic growth or go-to merger is off the table, then they don't need that kind of capital for any inorganic opportunities. Also, organically as well, their businesses are doing quite well. They are free cash flow positive. They have one loss-making business called fintech, but even their growth is quite sustainable and ecosystem driven. So I don't think that they need quite a bit of capital over there. So apologies, I don't have a very good answer that why they are doing that capital raising.
Okay, we'll keep a watch out for that. Okay, thanks, Husseini, for that. Let's bring in Amirul, a chart guy, for a couple of trading ideas. Amirul, what have you got for us today?
Hi, Dylan. It's been a while, so let me share my screen first. So before we go into our technical buy call, I'll just highlight quickly on the Straits Time Index. So if you look at the chart over here, its strong bullish run since its April 2025 low appears to be losing steam as it has moved in a sideways range. So I could basically draw a rectangle pattern over here. So you can see it has been trading within this pattern over here. More importantly, the index has broken below its 21-day EMA line for the first time since mid-April of 2025, raising questions about potential market weakness. That said, the market could still rebound and continue its uptrend, but it's important to stay mindful of key levels. For example, we view the 50-day EMA line currently at 3870 as an early support line. So if the index breaks below this level over here, it may be time to shift to a more risk-off stance. On the global front, the energy sector, particularly oil and gas, has been gaining momentum. If you look at the chart of Brent crude oil over here, last week it has received the largest increase of the year of 2025. Other assets like safe haven assets like gold as well has been, has been testing its all-time high line over here, right around its 3440 line over here, in which we believe it could be making a new all-time soon as well, given the current momentum. So in line with this trend, for our Singapore pick, we are issuing a technical buy call on gold-related counters, such as CNMC gold line over here. So it has been in a nice uptrend since its January 2025 low, but then after its 23rd of April 2025 sell-off, it has been in a sideways. But then within its sideways, it has also completed its inverted head and shoulder pattern over here. So you can see its first shoulder, its head, and also its second shoulder. And price, last Friday has just broken above its neckline pattern with a strong gap up and increased volume for the past 3 sessions. And if you look at today's price movement, it has been unchanged despite having an early bullish run. But overall, the uptrend structure remains intact. And we expect that since the price is far off from its 21-day EMA line, price might consolidate for a little while, right above this neckline over here, around its 0.445 level. But then we believe it's going to rebound higher and might test our next resistance level at 0.590. Maybe you could put, if you are making this trade, maybe you want to put your 50-day EMA line as your support level at 0.410, but our support level remains at 0.400. So just be mindful of this trade and put your stop loss tag. So that's all for me today. Over to you, Dylan.
Thanks, Amirul. Thanks for joining us. Now, very quickly before we go, I just want to highlight Frencken, which Jarek has reiterating his buy on. They made about a 63 million investment in a new 28,000 square meter facility in Kaki Bukit. And that's not just about space, it's also about smarter growth. With consolidated operations and state-of-the-art clean rooms, they're setting the stage for some gains in terms of efficiency, capacity, and customer service, especially as the semiconductor sector starts to ramp up. Now, looking at momentum, Franklin's key clients, especially in semiconductors and life sciences, are expanding in Asia, and this facility puts Franklin right where the action is. There are long-term customer relationships, even some sole-sourced ones, means that growth isn't speculative, that there is some of that growth baked in. Plus, manufacturing in Singapore could mean lower cost versus Europe for some of them. So there's a direct lift to margins as well. Plus, the new layout streamlines workflows, so there could be faster cycles and lower overhead cost per unit as well. Even with big capex, Frenken's net cash is in net cash territory with rising free cash flows, and dividend yields are hitting about 3.6% by 27. Forward PEs are around 8.3 times FY27. So there is some clear upside in terms of runway, especially with about 22% EPS growth for that year as well. So that remains one of our top picks in the tech manufacturing sector. With that, we've got a couple of events coming up. We've got Nordex numbers out on the 18th, inflation rate for Singapore out on the 23rd, bank lending, which we'll be keeping a very close eye on, out on the 30th of this month. With that, unfortunately, we are out of time. Thank you so much for joining us. Have a profitable trading week and see you next week.